This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. Depreciation. Now we're going to split this into 3 sessions. In this session, we'll discuss what we mean by depreciation, and I'll show you how we actually calculate it. In the next session, we'll look at the double entry, how we record the depreciation charge. And in the third session, we'll look at what happens if we revalue an asset. However, this first one is looking at what we mean by depreciation and how we calculate it. And although you can read page 43 yourself later, let me explain using the example 1. In example 1, it says Sarkans has a year end of 31st December each year. On the 1st of April 2002, he buys a car for $12,000. He expects the car to last 5 years and to have a scrap value at the end of 5 years of $2,000. Now, all we mean by the scrap value is effectively its sales value. And strictly by scrap, we're saying if the car were to completely stop working after 5 years, we'd still be able, hopefully, to find somebody to buy it off us, even if it's just for the metal. But whatever, we expect after 5 years it'll be worth $2,000. Now, where those figures came from, for the moment, is irrelevant. We think it'll last 5 years. We think we'll sell it for $2,000. Now then, we have a car, and if you think back to what we did in Chapter 2 and Chapter 3, a car is capital expenditure. We expect it to last more than 1 year, and it'll appear on the balance sheet as a non-current asset. That's fine, except what's the difference between buying a car and paying electricity? We pay electricity each year to run the business. Maybe we spend $500 a year, and we say, that's an expense of running the business. It appears in the income statement. Well, you can argue in the same way. A car. We need a car for the business. It's an expense of running the business. And in fact, how much is this car costing us? The net cost of the car. We're spending $12,000, but we do expect that after 5 years we'll get back $2,000, so it's costing us a net $10,000. And again, you can argue that that is an expense of running the business, except, of course, that this is an expense that'll last us 5 years. We won't need another car for 5 years. So there is an expense, but unlike electricity, where maybe it's $500 a year or $1,000 a year, with something like a car, because it lasts for more than a year, here it lasts 5 years, the expense needs spreading. We are going to charge an expense in our income statement, but we're going to spread that $2,000 over the life of the car. And we'll say the expense each year, or the depreciation expense each year, well, again, the original cost was 12. We expect to get back 2, so a net 10,000. And we'll spread it over the life of the car, which is 5 years. Well, 10,000 divided by 5, it's 2,000 per annum. And as I'll write down in a minute, in our income statement we will charge an expense, but at the rate of 2,000 a year. And we'll also look at how it appears in the statement of financial position, the balance sheet. So go back to the example. It wants us to calculate the depreciation charge for the first 3 periods and show how they'll appear in the financial statements. Well, let's do it. First of all, the first year, in the income statement, we'll show an expense along with all the other expenses. There'll be rent, electricity, there'll be depreciation expense. We're charging at the rate of £2,000 a year. The only thing is here, if you look back to the example, our year end is the 31st December. We bought the car on the 1st of April. And so our first year to December 2002, in fact, we've only owned it for 9 months, April to December. And so for the first year, we'll take 9/12 of the expense, which is 1,500. So that's the expense in the income statement. And our statement of financial position or balance sheet, well, we're going to show the car. Remember, it appears as a non-current asset. But although the car originally cost us, how much was it? 12,000. This car, remember, we're using up over 5 years. And we're saying, well, we've effectively used up 1,500 of that car, and so we'll reduce its value by the depreciation of 1,500. Now the value on the balance sheet is 10,500. However, accounting standards do require that we show that breakdown. We have to show what the original cost was and how much depreciation we've deducted. The analysis, the breakdown of the final value. Now, big companies often show that analysis as a separate note. Doesn't matter. You can either show it on the balance sheet or as a note, but that information must appear somewhere. However, that's the first year. Let's now do the second year. Year 2, the expense. Well, second year we've had it the full 12 months, and so we'll have the full 2,000. On the balance sheet, again as a non-current asset, we show the original car. We show the original cost, 12,000. But of course, we're going to reduce its value by another 2,000. We deduct the total depreciation, or the other word for that is accumulated depreciation. Now remember, in the first year we deducted 1,500. In the second year we're going to deduct another 2,000, so a total of 3,500 to deduct, leaving us with 8,500. And you can see what's happening. Every year we're going to reduce the value more. Every year we've got the expense in the income statement. So let's just do the final one, year 3. In the income statement, again we'll have had it for a full year, so the expense will be 2,000. On the balance sheet, well, although the value will fall by another 2, remember we need that breakdown. The original cost was 12,000. The total or accumulated depreciation, it was 3.5. An extra 2,000 is 5,500, bringing the value down to 6,500. That's the value for the balance sheet. There is the analysis. So, I hope easy enough. 2 things though, before I show you the other way for the exam. Firstly, you may be worrying what's going to happen when we've owned this car 5 years? Because of course it's not unlikely, it's possible, but what'll probably happen is we'll sell the car earlier and not keep it the full 5 years. Also though, even if we don't sell it, the chances of it lasting exactly 5 years and being worth exactly 2,000 are very small. Well, we'll deal with what happens later. For the moment, all I'm concerned about is how we've calculated the depreciation. And for so long as we own this car, what the effect's going to be in the income statement balance sheet. Secondly, and very importantly, the reason we're doing this is to spread the cost. In total, this car is costing us 10,000. It's over 5 years, so we're charging 2,000 a year. As a result, the balance sheet value will keep falling. However, the chances of the car being worth exactly 10.5, 8.5, 6.5, well, it's virtually impossible. We are not doing this to show a true value in the balance sheet. The value of the car almost certainly, of course, will fall, but we are not trying to show a true value. The true value of the car might be higher, might be lower, but that's not the purpose of depreciating. It's to spread the cost over its useful life. Alright, well, that's one way of dealing with depreciation. In practice, there are lots of ways you can depreciate, and the accounting standard allows any way. It's whatever you think is most sensible. For the exam, though, you need to be aware of 2 ways. This way, that we've just done, is known as straight line depreciation, an equal amount each year. So that's what we've done in that example. Very, very straightforward. The alternative way, it is a tiny bit less obvious. The alternative way for the exam is something called reducing balance, or reducing instalment. And to show you how that works, look at example 2. We'll do this below on page 45. So example 2. Zils has a year end of 31st December each year, and on the 5th of April we buy a machine for 15,000. This time, instead of telling us how many years it's going to last and what its value is going to be, it says our depreciation policy is to charge 20% reducing balance, with a full year's charge in the year of purchase. Now again, we're going to do it for the first 3 years. And so let's have a go. First of all, the first year. First of all, in the income statement, we're going to have our depreciation expense. But the way we calculate the expense, we take a fixed percentage, which will be given. Here it's 20%, but use whatever percent you're told, obviously. The expense will be 20% of the value of the machine. How much was this machine? Well, it cost us 15,000. And so the expense, 20% of 15, is 3,000. Now then, it's 20% per annum. And what we could do is, just like in the previous example, because here we've only had it for a fraction of a year, then take a fraction of it. We never worry about days, so 5th of April to the nearest month is 9 months. We could take 9/12 of that 3,000 because we've only had it for a fraction. However, what's very, very common in real life and in exams is what you're told here. Here it says, in the third line, there's a full year's charge in the year of purchase. That because we're not trying to show exact values, rather than mess around and take fractions, bear in mind a company may have 100, 1,000 cars. Here it says a full year's charge. So read carefully. If they say a full year's charge, then you take the full 20%, you take 3,000. If on the other hand they said to time a portion, then you'd take a fraction, you'd count the months. And obviously read the written parts of this chapter when we've finished. You'll see that's written down for you. However, there's the expense in the first year. And on the balance sheet, in the same way as always, under non-current assets, this time we'll have a machine. We'll take the original cost, which was 15,000, but we'll deduct the total, the accumulated depreciation, which so far is 3, bringing us down to 12. No problem. However, to be clear precisely how it's working, we need to look at a couple more years. So look at the second year with me. Again, on our income statement, we'll have the expense. But now here I can show you the full story. We'll take the fixed percentage, 20% here, of the value of the machine. Well, the machine is no longer worth 15 because at the end of the first year we depreciated. We'd ended up with a balance sheet value of 12,000. And so in the second year we take 20% of 12,000, which is 2,400. The balance sheet reduces its value by 2,400. So the original cost, 15,000 as before. The total depreciation, it was 3, another 2,400, the total is 5,400. The balance sheet value is 9,600. Let's do the third year. If you want, pause the recording, have a go yourself and then check. But in the third year, the expense, 20% of balance sheet value. The balance sheet value is now, at the end of the second year, it was only 9,600, which gives us what? 1920. And finally the balance sheet. Original cost 15. Total depreciation. So far we'd had 5,400. Another 1920 gives us a total of, I think, 7,320. Giving a balance sheet value of 7,680. And there we are. Now I'm not going to carry on and do a fourth year and so on. One nice thing about this approach is because we don't have to estimate how many years is it going to last, because in theory this would carry on forever. Each year 20% of the balance, the next year it'll be 20% of 7,680. It'll get smaller and smaller. In the exam we never worry about cents unless the question asks you to. You do things to the nearest dollar. So it's a rather nice approach. Needs that little bit more care, obviously, because make a mistake in one year and you automatically get things wrong in the next year. but that's reducing balance. In practice, those two approaches, straight line and reducing balance, are by far the most common. You can use other methods if you think another method is more sensible, but it's usually one of those two, and in the exam it's those two methods to be aware of. Okay, so those are the methods. We'll have a pause. In the next section we'll look at the debits credits, which are the same whichever method we're using.